Okay, 17. We're not going to spend a whole lot of time on the conceptual theory behind revenue recognition because that's all been changed in the new. And I'll introduce that on Tuesday and then follow up on Thursday as to what the new standard is. But in general, historically, revenue can only be recognized and booked when the earnings process is complete. That's unchanged. They've just added some more detail to all of that. And more importantly, or equally as important, collectibility is reasonably assured. Because one of the abuses that has occurred historically is the sales to an uncredit-worthy customer. If you're a tractor dealer and you're selling $75,000 combines, there's no better way than to get a couple of farmers that you know can't pay for it to accept a Christmas Eve present of a combine, knowing full well that before they get a chance to use it to plow a single acre of land, you're going to repossess it in the springtime. But you get the revenue. So you've got to ensure, and the auditors look at this. If you have a term loan out there and nobody made the January payment, nobody made the February payment, nobody made the March payment, by the time they come in to do the field work in late March or early April, they're more than likely going to back that sale out. Okay, so this area, and this is in the new standard, just slightly different language. All right, so this was the old standard, SAB 104. Persuasive evidence of an existing arrangement. Delivery has occurred. The price is fixed and determinable. And as we just mentioned, collectibility is reasonably assured. 3 ways of recognizing revenue. Either you recognize it in advance of final delivery, and that's what we're going to be talking about here. That's long-term contracts. If you're going to build a building over multiple years, it takes you 5 years to build a building, then you need to recognize revenue along the way. Otherwise, you have zero, if that's the only thing you're doing, is building this building, you've got nothing to recognize on an income statement for multiple years until the project is finished. That's the completed contract method. An allowable alternative, but not a very pleasant one. It's hard to convince your creditors that you're doing a good job when you've got a zero or a huge loss for 5 years, and because you still have administrative expenses and such. And then all of a sudden, boom, you got all this revenue and cost of sales in the final year. The usual recognition is the sale when you finish it. The earnings process is finished, you have completed it, someone has showed up at your store, taken an item off the shelf, taken it to the cash register, paid for it, process is finished. And then lastly, a deferred recognition. This is commonly used for installment sales, which I don't know how much of that goes on anymore. I think Walmart and Target still do something called layaways. I don't think most people use it anymore. Maybe I'm wrong. I'm not quite sure. But you don't finish the earnings process until the item is paid for. Okay? So that's an installment sale. Economic substance takes precedence over legal form. That is unchanged. We want to look at what is in reality happening here, not some sort of legal shenanigans where you're trying to generate revenue that hasn't been completed yet. And then who has assumed the risk and benefits of ownership? If the item is destroyed tomorrow, who takes the loss? Who files the insurance claim? All right? And that's a key in even the new standard. And then, of course, we've talked about collectibility. All right, percentage of completion is what we're going to focus on in this chapter. So percentage of completion is, well, let's go through all this. We've already talked about it. This is just a chart on the various alternatives. All right, here we go. Percentage of completion is taking a portion of the earnings on a long-term contract in each year based upon performance that has been accomplished. There are alternatives on how you calculate that performance. In order to use this, you must be able to make reasonably dependable estimates as to not only how much have you already performed, but how much do you have left in order to complete the project. Now, most construction companies possess this. They track contracts extremely tightly in order to ensure profitability. So they know exactly on a daily basis how much has already been put into the project and how much is left in order to finish it. All of these costs are tracked. Labor hours, machine hours, materials, overhead, it's all tracked in order to be able to manage these types of complex projects. And you must have clearly enforceable rights. And this is quite common. In a long-term construction project, you will have billing milestones built into the contract. So in other words, when the engineering blueprints are finally signed off on by everybody, by the architect, the engineers, the customer, and the construction company, have all signed the final plans, normally a billing milestone kicks in. You get to bill the customer a portion of the contract price and collect it. When permits are let, or the foundation is poured, or when you top out a building. Top out is that you finish pouring and putting all the ironwork in for the very last floor of the building. There's a billing milestone. When you finish installing the mechanical, the plumbing, the heating and air conditioning, the elevators, billing milestones. So these are set out in the long, complex contract that is always associated with these types of projects. So you must have clearly enforceable rights. And then not only the buyer is expected to satisfy their obligation, and this could change. Sometimes you get into 2-3 years of a 5-year project, and all of a sudden economic conditions change, and the buyer that is going to eventually assume control of this building no longer has the wherewithal to finish it. So now you've got to go find somebody else. And then you, as the company, can finish. Construction companies also run into hard times. And you need to be able to satisfy your auditors that you have the economic resources in order to complete this contract. And that can be very tricky when a project goes south and starts losing money. All right? Okay. Options. You can either measure input or output. All right? You can either measure what you put into a project or what the customer is getting. Input is what overwhelmingly companies use. And within input, overwhelmingly they use cost-to-cost method. This is dollars. How many dollars have been incurred on this project? How many labor dollars have you paid your direct labor force? How many material dollars have you issued to the job? How many subcontractor dollars have you incurred? All right? How much overhead have you charged to the job? This is what we're going to focus on starting Tuesday with the problems. Is we'll look at the percentage of dollars that have already been expended towards the project, add in the estimate of what we expect to take to complete the project, and then get a percentage. Divide the number that we've already spent or incurred by the total that we expect the project to cost, and that can change from year to year as the project matures. That tells us the percentage it's completed. Multiply that, which we'll see here in a second, by the contract price. The other input option is to use some sort of other thing besides dollars. You could run an entire project on labor hours. If that's all you're doing is supplying labor, that may make sense. If you expect the project to take 100,000 man-hours and you have already expended 50,000 of them towards the contract, you're not providing material, you're not burdening it with overhead, you can use labor hours. Machine hours, tons of material. There's other things other than total cost. And then the output measures, they like this. They think it's theoretically preferable. It's the expected results of the contract. I'm not going to focus on that because I've done percentage of completion in a couple of my jobs in the past, and I've not used that. I did it in the aerospace business. Well, both of them were in the aerospace business. One was a big government contract up at Tinker Air Force Base. It was $1 billion worth of contract. It was the largest refurbishment of an existing Air Force base in the history of military aviation. And the other one was that big green aircraft. If those of you that have been to my office, that was a 3-year project out there at those orange hangars at the San Antonio International Airport. That was percentage of completion also. So I've done this twice. At both times, we use total dollars. All right, so that's what I'll focus on here. All right, so let's look at an estimate. We're going to build a stadium. We're not going to build a very fancy stadium because the contract price is only $700,000. Not a very fancy stadium. Maybe a middle school stadium for this. I mean, even our stadium here was 4 times that price. Here are the costs that are incurred in each and every year, as well as at the end of 2013, 14, and 15, what we expect in total dollars to finish the job. We also have partial billings. These are these billing milestones that I mentioned. Maybe when the plans were signed off on, when the foundation, maybe when the stands go up, things like that. The partial billings to customers, as well as what is collected. So, at the end of the first year, you have incurred $100,000 out of a total expected cost of $500. You're 20% done. The 100 divided by 500. 20% of the contract price of $700,000 is $140,000. That's the revenue that you recognize in year 1. In year 2, we have what is known in the construction business as project creep. Because now, rather than earning $200,000 on this job, which was our end of year 1 expectation, price of $700,000 and an estimated cost of $500, now we're only going to earn $150,000 because our total cost has gone from $500 up to $550, of which we've expended $186,000. We're now 52% finished with the job. Multiply that by $700,000, we get $364. Subtract the $140 that we've already recognized, and we have 2014 revenue to book of $224,000. Subtract the cost of $186 that we incurred during that year, we have a gross margin recognized in year 2 of $38,000. And then in the last year, creeped up again another $50,000, at which point in time they more than likely fired the building supervisor. $600,000 was the total cost. We've made $100,000 on the job, 100% complete now. Subtract the $314,000 that we expended in the final year, and we get a $22,000 gross margin for the last year. Okay? We still made money on the job. We still made $100,000. It wasn't as good as the $200,000 that we initially expected, but as we'll see here in a second, worse things could happen. And this is just a normal one. So this is the normal scenario. The job stays profitable. We haven't over accrued revenue or profit into an earlier year. All right? Does that make sense? Yes, ma'am.
Where did we get the 314?
That was given to us. Oh, yeah, right here.
Oh.
So we expended 100 the first year, 186 the second year, and 314 the last year. So this is just accumulation of it. So this is just the 100 plus the 186, and then for a total of 286, and then plus the 314 brings us to the 600. So that's just accumulation of it all. All right? Well, this is just completed contract. All right, so the journal entries. As you charged either labor or materials or overhead or subcontractor invoices, as you charge to the job day in and day out, you debit an inventory account, construction in process. The other side of that could be, direct labor expense. It could be accounts payable. It could be material inventory. It could be cash. Who knows what the credit side of it is, all right? Because it comes from a variety of sources. As we record the partial billings, we debit accounts receivable and we credit. This is a contra asset account that is used in long-term contracts called partial billings. It's an offset to this inventory account. So inventory on a construction company's balance sheet will show construction in process less partial billings. And you will report the net of that. And you'll see here in a second why. Because there's something also getting ready to happen that is highly unusual from anything that you've seen thus far. Then as we collect accounts receivable, that's just a straightforward debit to cash, credit to accounts receivable. Now, at year end, we're going to take that margin, that profit, that gross profit that we just earned on the first year, the $40,000, because remember we accrued revenue of $140,000. That's our credit to construction revenue. And we are taking out of construction in process, and we're taking to expense the construction expense of $100,000. But we're adding to the inventory account the margin. So the difference between the expense that we take to the income statement and the revenue goes into the inventory account. I know it doesn't make sense, but that's what we do. Okay? So then in the second year, you do the same sort of thing. You start accumulating the cost. You bill out the current year's partial billings. You collect some cash, and you put the margin once again back into the inventory account. So that in the final year, after you get finished accruing the last of the cost, the last of the billings, and the last of the collections, then your closeout entry is a debit to this partial billings, this contra inventory account, and a credit to the inventory account, both of which will have all of the cost and all of the profit on the job. So at that point, they zero each other out. All right? And that's it. for percentage of completion. Okay? So those are the journal entries and the calculations. This is the balance sheet. As I indicated up here, you've got into current assets. You have a construction in inventory, construction in process inventory account, less in the contra inventory account of partial billings. All right? Okay. So what happens when everything doesn't go as planned? I mean, even in that last example, it didn't go as planned because we originally planned on making $200,000. We wound up making $100,000. What if it's even worse? There are two types of losses that need to be accounted for in this type. Either there's a loss in the current period, but still the contract as a whole is going to make money, or the worst case scenario, the entire contract is going to go and lose money. Let's look at how we account for both. All right. The loss in the current period. Instead of in the end of the second year, in 2014, rather than $264,000 of expenses to left, because at that point we were still expecting a profit on the job, the stadium construction job, of $150,000. What if it was only $50,000? So in total, we're expecting not $650,000, but we're expecting, I'm sorry, not $550,000, we're expecting $650,000 in total costs. Well, what happens is that the construction cost incurred to date is still the $286,000. That's the $100,000 that we spent the first year and the $186,000 we spent the second year. But now our estimate is $364,000 for a total of $650,000. Now we're only 44% complete. Remember, in the first scenario, we were 52% complete. So with the 44% of $700,000, we get revenue of $308,000. Of which we've already recognized $140,000. So the current year's revenue is only $168,000. However, we got $186,000 in costs. So in the second year, the first year we took $40,000 worth of profit. In the second year, we're going to report a loss of $16,000. Okay? So in total, if we wind up finishing this for the $650,000, we'll get a profit in the third year of, let's see, 40 plus minus 18, so 22. We'll get $28,000 worth of gross margin in the third year. Because in total, the project is still going to make us $50,000. Okay? And we'll do problems on the board Tuesday on these types of scenarios. Right? So this is something that has occurred that generates a loss in a single year or multiple years, but not for the whole project. All right, what happens if the whole contract goes south? Let's estimate that at the end of 2014, the costs to complete now are $429,000. That now is a total of $715,000. So now we're going to lose money on the entire contract. In this case, we're going to back in to the total cost for the second year, and we're going to drive out all of the profit we've already taken, the $40,000 that we took in year one, plus the total loss of $15,000, and book it all into the current year. Is the minute you know the worst case scenario is happening, we report all of it in the year that we know it. So we'll have zero margin in the last year. And we'll take all of the $55,000 loss in the current year. Okay? That's how that works. And we'll, once again, go over a problem on the board on Tuesday that'll show us how that is calculated. It's in keeping with the conservative nature of accounting. The minute we know there's bad news, we would take all of it now. Okay? Does that make sense? It will come Tuesday. Have a good weekend.